In our view, interest rates are just one of the many variables that can play a role in the pricing of stocks. But to be clear, stocks don't normally need rate cuts to perform well, and rising rates aren't necessarily negative for returns either. But when answering any question like this, we always like to go back to one of our basic rules about the market, that stock prices tend to change based on the difference between reality and expectations. The market embeds in its expectations for both earnings and short-term interest rates a view about forward economic growth and inflation. And growth and inflation expectations are two of the best explanatory variables for changes in interest rates. So it follows that if the market expects growth and inflation to be relatively high, the expectation for future rates can be somewhat high as well. So when interest rates increase to meet that strong cyclical reality, you shouldn't expect the market to skip a beat. Indeed, this is generally the environment we've been in since the bull market began in October 2022, with growth and inflation, both above trend, supporting those higher interest rates. It's actually very common to see the market perform well alongside rising interest rates. In the same way, weaker growth and inflation environments with lower interest rates can also be good times to be invested. The thing that matters the most for the market is how the economy evolves relative to its prior expectations. So when viewed that way, it's pretty clear that central banks like the Fed really play a secondary role in determining interest rates. Economic conditions and the market's expectation for those future conditions tend to lead the way. So while the Fed could theoretically raise rates into a weak economy or lower rates into a strong economy, in practice, its dual mandate typically precludes it from doing so. So the question to focus on is less about what the Fed will do next and more about how the economic conditions will evolve relative to expectations.